So first of all, thank you very much for having me. I actually think that the microphone is not going to come over the speakers. I think the microphone is mainly hooked up for the video recording that's back there. So just let me know if you can't hear me. It's all good. All right, so the title of my talk today is Isolated Dividends, a New Asset Class. So let me tell you a little bit about myself and how we got to this research topic. So I'm originally from the Netherlands, which I'm sure you can hear pretty much immediately, and did my undergraduate in the Netherlands in financial econometrics. At the end of that, I went to work for Goldman Sachs in London, after which I did my PhD at Duke University. I graduated from Duke with my PhD in 2008 and joined the Stanford Graduate School of Business. And in 2014, my wife got a job at Goldman Sachs here in New York, and so we decided to move to the East Coast. So I've been at the Wharton School since 2014, where I teach the MBA core finance class. The reason why we started thinking about isolated dividends is that academics have a lot of ideas about models that could explain the stock market and how they work. Now, one thing that academics like is that when a model has been proposed, that you're confronted with a new set of data that the model was not designed to explain, and then we can see whether the model actually gets the pricing of those particular claims in this case correctly. And as it turns out, and that was part of the reason why my academic career has flourished the way it did, was that the way that the dividends behaved was actually very different from what a lot of the models actually predicted they would. And so I'm going to show you today how these dividend claims, these isolated dividends actually do, how we should think about them. I'm going to draw some analogies with zero coupon bonds, because in many ways dividend strips, or isolated dividends as they're called, are just the stock market equivalent of zero coupon bonds. And that will also give us a lot of guidance in how to think about the pricing of these things and what is priced into the price today relative to the dividend that will be paid out over some horizon, and therefore what we can learn from them, but also what its return properties are. So what is the risk? What is the idiosyncratic risk, meaning the risk that is uncorrelated with the rest of the market, versus the systematic risk, the part of the risk that's correlated with the aggregate stock market. And then we'll see what the average return characteristics relative to the risk characteristics are, and therefore how it would nicely fit into a diversified portfolio of a broader set of investments, and how we can add isolated dividends to it. Now, as is my general policy, I am just simply going to present the academic work that I did and how it was published. And so the results that I'm going to show you are just going to be that. So the results I'm going to show are not particularly tailored to current events like you see them today, because that's just not the game that we're in. I'm just going to show you the independent research that we have done on the topic and what I think we can learn from that. All right. So these are the three papers that I'm particularly going to be talking about. As you can see, the first work that we started doing on the topic was in around 2010, leading to that first publication. We've done several pieces of work on it afterward. Okay, so what's the history of isolated dividends? Well, there have been attempts historically to try to take a look at a stock investment and try to separately trade the piece that gives you price appreciation and the piece that gives you the dividend income. As we know, when you invest in a stock, you make a return for two reasons. The price changes and you earn a dividend. What if you could simply split up these two pieces? And so in the early 80s here in the US, there were some experiments with trying to make those two things trade separately. But in the end, that didn't really take off at the time. Now, with the growth of the derivatives markets, though, derivatives have one particularly interesting characteristic, which is if you buy a call option on an underlying stock, then until you exercise that option, you don't actually own the stock. And therefore, any income or dividends that that stock pays, you are not entitled to. And so only when you exercise and then you own it, that is from that point forward, you're going to earn the income that is associated with the stock. But that then also means that if you want to properly price things, you want to properly price the option, you need to know how much that dividend is worth. Because as we know in the pricing formulas that we use for derivatives, we use the underlying. But the underlying isn't sufficient information to price it if there is a cash flow that's there, and therefore we need to know what that separate cash flow part is worth. the dividends became more and more of an important part also for derivatives traders to try to separately trade this piece because they wanted to hedge the dividends positions as well that came out of the derivatives trades that they were doing. And so I think this is one of the reasons why, particularly over the last decade, we've seen such a rapid growth of the separately traded dividend market. Or I'm going to call several different names for the same thing. So some people call it dividend strips, and I'll tell you in a little bit why it's called strips and what the analogy with zero coupon bonds is there. Some people call it isolated dividends. We'll just use that terminology interchangeably. So if you think about investing in a financial instrument, as I said, then the return that you make is going to be coming from two separate parts. The total return, as we call it, is going to be, also for a bond, it's going to be partly due to the price appreciation, and it's going to be partly due to a cash flow that's being paid. Right? That is a coupon. Now for the stock returns, what you get is you get the dividend paid, you get the price appreciation part. This second part is often what we call the dividend yield. So now you can say, well, why can't I just trade the dividend separately by just doing the following strategy? I buy the stock today, I hold it for a bit, I collect the dividend, and then I sell it off. So why doesn't that just get me the dividend? Well, it doesn't only get you the dividend, it also gets you the price risk. Because at the time that you sell the stock, who knows what you will be able to sell the stock for at the end of your investment horizon. So suppose you want to do this for a year, then you can collect a dividend over that year, but you're faced with the price risk of having to sell the instrument at the end of the year. And as we know, stock prices can be quite volatile. So is there a way in which you can eliminate that price risk part and simply say, I just want to buy the dividend, say, on the S&P 500 index or the Euro Stoxx 50 index or the Nikkei 225 index. Simply collect the dividend at the end of the year. I want to have the aggregate total dividends paid on that index over a whole calendar year, and I don't want to have anything else. So I pay a price today, and I'm just getting the aggregate sum of the dividends. And then, of course, the question is, if you invest in such a thing, well, what return would you make? How risky would that be? Now you can say, well, didn't you just say that you eliminated the price risk? So is there much risk left? Well, as it turns out, there is quite a bit of risk left. And what is that risk? Well, it is possible that over that calendar year, firms will be forced to cut their dividends. So if a financial crisis would hit, and therefore a large fraction of indices today are going to be financial firms. If during a calendar year those financial firms are forced to cut their dividends, then of course relative to the price you pay today, the amount of dividends that you get by the end of the year might actually be lower than what the price suggested. But what is going to be true though is that the amount of risk compensation that you get for the amount of dividend variation that we see, and I'm going to show you pictures in a little bit, is going to be really high. Meaning just for that dividend risk, you're going to get a large compensation in terms of average return. All right, I said all of this already. So bond returns have coupons. If you could only trade separately the coupon is only subject to default risk if you eliminate the price risk there. For stock returns, we all know that there are large price risks with a stock. If you only take a bet on the first dividend and you just buy the dividend separately, there's still some risk, which is particularly that the firm might cut its dividend, or the firms in the index in aggregate might cut their dividend. So can we eliminate price risk? Well, as we all know, and this has become sort of the staple way of pricing bonds that have coupons, is to say, well, why don't I take the bond? The bond is a collection of payments, and I simply strip them apart. So I turn them into these separate pieces. Right? So one way to explain no arbitrage price theory is to simply call it Happy Meal economics. If I know what the price of the burger, of the fries, of the toy, and of the drink is, those are the separate coupons plus the rest of the bond, then if I take the sum of them, then that should tell me the price of the whole bond. Of course, everybody calls this Happy Meal economics, but the irony is that for Happy Meals, it actually doesn't hold because the sum of the individual pieces is more expensive than the meal itself, but you get the point. So now, can we do the same thing with stocks? Well, a stock has value because it also gives a stream of cash flows that it pays. So can I also, just as I do with bonds, where I strip it apart into its individual coupons and its principal at the end, can I try to strip apart the stock into the value of its individual cash flow payments? And so this is one of the reasons why for bonds we call it separate trading of registered interest of principal of securities. And so therefore this strips terminology, you can just apply that to dividends as well. And therefore sometimes people call them dividend strips for exactly the same reason. Now, of course, you can then also, just as much as with zero coupon bonds that have a maturity, you can think of dividends and taking bets of different dividends at different maturities as well. So you can say, well, I just want to buy today the entitlement to all the dividends on a particular index, say the S&P 500, for the whole calendar year of 2020. Let's see how much you're willing to pay today to get the realized dividends for 2020. But what, of course, you can also do is you can do today and do it for 2021 or for 2022. And so by calendar year, you can split up and you can see how much are you willing to pay today for the aggregate dividends for that particular calendar year. And so therefore, just as much as we have zero coupon bonds that have a particular maturity that you take a bet on, you can also take a bet on a particular year of dividends. Now, why is that going to be important? Well, as I'll show you in a little bit, if you run a macro shop and you're sort of interested in taking macro bets, then taking these sorts of bets on dividends can be very useful in terms of betting on when you think the recession will end. If you think that there will be a recession in 2020 and therefore dividends might stay constant or even be cut, but you think that we're back in a boom by 2024, then the dividend market allows you to take a bet on how long the recession will last and how strong the recovery is going to be. So as part of a macro bet sort of portfolio, the dividend strips allow you to precisely by horizon sort of take bets on the business cycle. All right, so a bit of math. What is the standard equation that we say for a zero coupon bond for which the face value is 100? Well, we say the price today is the face value discounted with a continuously compounded rate over n periods. And then this yt comma n is the bond yield today for a cash flow that pays out in n periods from today. Right? And so how do we generally compute the bond yield? We simply take the log of the bond price over 100 and then minus 1 over n gives us that yield. Now that yield still has a bunch of information in it. A lot of people call this yield completely risk-free, right? They say you call it the risk-free interest rate often. But of course, as we all know, it isn't quite risk-free because one part of this bond yield is going to be inflation. And so we'll also have to think a little bit about how dividends are going to help us with inflation. Because one of the characteristics of a bond is that the cash flows are fixed. Once you set the coupon rate and the principal, then that's the end of it. There's no adjustment of the cash flows across the maturity of the contract. And therefore, once we see inflation in markets that is higher than expected, then of course this is this is an upside for borrowers, but it's a downside for lenders. And so people are looking for real assets that allow them to hedge against inflation. So as long as dividends over time are increased with inflation, which they are, dividend contracts are also going to be interesting as inflation hedges. And I'll talk about that a little bit too. So once we see here how the government bond is priced, we can essentially do a very straightforward mapping to how dividends are priced. So let me tell you exactly how it works. The price of the dividend is here on the left-hand side. It's going to be equal to the dividend today, but we don't get the dividend today. No, what we get is we get the expected value of the dividend at maturity. So between today and maturity, the dividend is going to be growing at a rate G. So if you want to take a bet on a dividend strip that is the collective dividends in 2023, then you need to make a stance on how fast do you think dividends will grow between now and 2023. That's reflected in this G part over here. Then, of course, we need to do some discounting of this expected dividend in the future. Well, the discounting, as we all know, starts with a risk-free part. But then, because dividends are risky, there's going to be some risk premium. Just as much as the average stock market earns a risk premium, there's also going to be a risk premium, an extra return that you earn, an expected return that you get by investing in dividends. In this particular equation, that is reflected by this term theta over here. Right? So it's exactly the same as here. There are just two things added, which says coupons don't grow, dividends do. That's why I have a G in here. Secondly, nominal bonds are generally considered to be risk-free assets and don't have a risk premium in them. Dividends have dividend risk, and so therefore for that dividend risk there needs to be some compensation, which is the dividend risk premium, which is this term theta over here. But you can see clearly what the equivalence is between zero coupon bond yields and zero coupon equity, which is again another term for dividend strips. Now that was the spot price. Of course, you can also structure it through a forward contract. I mean, there's been quite an active swap market already, and now there's also a futures market that trades dividend futures directly. And so if we go for the futures market, we know what the relationship is between the spot price and the futures price. It is simply risk-free discounting, and therefore, very conveniently, this Y term simply falls out. And therefore, you can see here that if I take the price-dividend ratio of a dividend strip, which is the price of the dividend divided by the dividend today, it essentially summarizes two things. It's the difference between the extra return that I can earn by investing in dividends and the growth component. How much do we think dividends will grow between now and the maturity of the contract? All right, so what I want to show you here is for the S&P 500, what this yield of the dividend futures actually looks like. And I'm also using a statistical model. In this particular case, we can use survey forecasts. We can do a bunch of different things that all lead to pretty similar answers. But what you see here is how much of the yield that we see in the data is caused by differences in expected growth between now and maturity. How much is coming from this risk premium component, and that risk premium component you can then interpret as the extra return that you earn on this particular dividend in excess of the risk-free rate. And so what you see is that for the S&P 500, the risk premium varies somewhere between 0 and 10%. So during extreme boom periods, it's closer to 0, and then during the 2008-2009 period, it's closer to 8 to 9%. Now you also see that certainly, as it should be, there's quite a lot of information about expected dividend growth in these contracts. So if you want to have a good recession forecaster and an indicator of what we think in the future will happen, then in terms of recessions, then this is one thing that you could add to your list of business cycle forecasters. Because the market prices in if it expects dividends to be cut. And under what circumstances would it expect dividends to be cut when a recession is coming? Under what circumstances would we expect dividends to be increased? Well, when a boom is coming. So you see here also the expected dividend growth rate over the sample. All right, so now once we start to look at other markets, this is for the Euro Stoxx 50. And you see there that the return profile becomes even more interesting in the sense that the average risk premium that you're earning on this contract is closer to 10% here. You again see that the yield already incorporates the cut in dividends that we expect to see over the next 2 years. So that is also there in that green line. And so you can nicely use these yields to decompose them into what extra return will I earn, and how much is due to expected growth between now and the maturity, and you see that in this picture. Now, for the Nikkei 225, very similar picture to what we've seen for the other two markets, right? So certainly the risk premium that we're earning is positive on average, and it's quite high. In fact, over this collective time period that you see here, essentially, these dividend futures contracts have all outperformed their respective indices themselves, meaning that investing your money in these short-term dividends gave you a higher return than compared to having invested in the underlying index, such as the S&P 500, the Nikkei 225, and the Euro Stoxx 50. So here, what I plot for you here are sort of the cumulative returns of these dividend futures contracts over their respective maturities. And then also because the dividend futures contract, if you remember, I took out the risk-free rate part, right? I took out the risk-free yield between now and the maturity. So to make it even more comparable to the index, I also need to take out some sort of risk-free rate for the index. And so I'm taking out the 10-year bond yield to make it comparable. So what you see here is by how much cumulatively over this sample period, you see that the dividend futures contracts have outperformed. Now another thing that is quite interesting is that with the exception of the US market, the shorter we are, so the shorter maturity claims actually have even higher returns than the longer maturity claims. Right? So there seems to be, in terms of the return pattern, almost this downward sloping term structure effect. If you may remember from bond markets, we're very much used that on average, the term structure of interest rates is upward sloping. It's pretty close to flat, but it's a little upward sloping with what we call the term premium. Some people think that right now the term premium is close to 0, but historically it's probably been close to about 2%. And so here you see that the term premium is actually negative for equity, meaning that the short-term claims earn, on average, higher returns than the longer-term claims, certainly compared to the longest maturity claim, which, of course, is the index. Right? The index itself, you really can think of that as a duration, the index has a duration of maybe 20 years or so. Right? So it's a very long-term investment because all these dividends, the whole perpetuity of dividends, that's what you're taking a bet on when you invest in the index. When you do the dividend futures, you take bets on individual dividends in a particular calendar year. So once again, you can simply fit the entire logic exactly into the same logic as that you would usually use for bonds. Right? You have a maturity for the bond. There's therefore a duration for the contract that you have. And therefore, by maturity, we need to know how things are priced. The dividend market exactly tells you how that is priced in the market. So what are the different ways to practically invest in these different dividends? And so I listed here for you 4 different ways. And as we are going down the list, essentially, particularly for regular investors, it becomes easier and easier to do it. And then a second thing that is important how we progress through the list is what are the available maturities that we can invest in. So as I said in the beginning, whenever you invest in a derivative, whether it is an option or a futures, if you do the futures or the option contract, you're not entitled to the cash flows up until the maturity. With the spot, you are entitled. So if I simply compare the difference and I go long the spot and short the futures contract, that's the same thing as taking a bet on the short-term dividend. And we all know if we look at index futures contracts, they have a liquid maturity up to what, a year? Most of the liquidity is actually sort of at the 3-month horizon, or even between the 1 and the 3-month horizon, I should say. You can push it up to a year, but that's about it. If you go to the European index options, then we're talking about longer maturities, but still not very long. If you think about LEAPs, the very long-term options that are being traded, we're talking about maturities up to maybe 2.5 to 3 years, right? And that's where that ends. Now, you can still, using the put-call parity formula, by combining it smartly with the index, you can still get a bet on the dividends, but again, up to 2.5 years. Then there's the dividends futures market, which essentially gives you access to longer maturities. Right? The dividend futures market goes up to 7 to 10 years. For a long time, it was just an over-the-counter market, and gradually more and more of the dividend futures are now being exchange-traded as well. And then finally, of course, there are now finally ETFs being introduced that give regular investors direct access to investing in dividends alone. Now, I said at the beginning that dividends could be useful to take a bet on the business cycle. So what I did in this picture was I simply took GDP, I took consumption, and I took dividends. And I sort of took out the low-frequency trend that we have in that data using what's called the Hodrick-Prescott filter. And therefore, I can sort of look at the cyclical variation of these different variables, which essentially are a summary of the business cycle. So when we see that the line is under its mean of 0, that means that we're in a recession for GDP. If it's above 0, that means that we're in a boom relative to the long-term trend. And so what you can see is that dividends, in many ways, are just levered bets, meaning expanded bets exactly on the business cycle. Right? If you're wondering how correlated are these things, let me just plot for you here how high the correlation is between dividends and GDP and dividends and consumption. And you do see that there is some variation in the correlation between the two, but you also see that the correlation actually is on average quite high. What is the period in which the correlation broke down? Well, it's not that surprising that it happened exactly in the 90s. Now, why did it happen in the 90s? Well, because the 90s was one of those exceptional periods where you were a firm. You would make the statement and say, you know what, I'm actually not going to increase my dividends because the internal investment opportunities due to the tech boom are so wonderful that we want to keep the cash inside, and we have more than enough opportunities for us to invest all the cash in-house. And so, but that's pretty much the only period for which that correlation is lower, still positive and relatively high, particularly sort of during the last period and including the crisis period. You see that dividends are very much correlated with how the business cycle operates. And therefore, I think as part of a macro bet strategy, I think dividend futures are a very nice strategy, a direct way of betting on the business cycle. Okay, so now you may say, well, you showed me that the returns on average are pretty good, particularly relative to the underlying index. Also, of course, particularly relative to the risk-free investing over the same period. I mean, I think everybody right now is desperately looking for investment strategies that can give us an extra 1 or 2% given to the extremely low return and yield environment that everybody has been struggling with. But we also know that returns don't come without taking risk. And so is it true that these dividends are particularly risky? And interestingly, the answer is going to be yes, if you look at idiosyncratic risk, meaning the risk in a standalone fashion. The way I usually talk to the students about this is, think of that type of risk as what risk would you have if you would put all your money in that strategy? But you also then immediately have to ask the question, well, who would do that? Who would put all their money in that one strategy, right? So we should not just look at idiosyncratic risk, we also need to look at systematic risk, meaning how does the risk of these dividends actually correlate with a globally diversified investment portfolio, right? And as it turns out, one way to measure that is what's called in the jargon the CAPM beta, meaning how much does the dividend return load up on how the aggregate stock market is doing. And as it turns out, the CAPM betas are very modest, meaning that I do get relatively high returns for a low amount of systematic risk. Doesn't mean that the idiosyncratic risk isn't high, so it is important that if you want to invest in these, you should do it as part of a diversified portfolio. But given how high the returns are, I would strongly recommend to add it as part of a diversified portfolio because you get a favorable return pattern relative to the systematic risk that you are taking. And that's one of the conclusions of our 2012 paper as well. So here, just to get a sense of how big the idiosyncratic risk is, what I'm plotting here for you is the price of the claim of the 2-year dividend strip price. So that's the price that you can buy it for. And then also I'm plotting, but shifted by 2 years so that you see realizations against prices, the actual dividend realization that you would have gotten 2 years later. Now remember that it's a futures contract, so the risk-free rate falls out of this because you pay for it at maturity and you get the dividend at maturity. So everything that is the difference between the two lines is really the extra return that you're earning. And so what you're seeing is that with the exception of the crisis, you see that the price of the dividend that happens 2 years later is substantially below what the realization of the dividend actually is. Right? So you see most of the time the green line is above the blue line, and then during the financial crisis, we do see that the price that you paid was higher than the dividends that you eventually received. And that pattern is the same for 4 different markets: the Eurostoxx 50, the Nikkei 225, the FTSE in the UK, and the S&P 500 in the US. Now here, what I'm plotting for you is what's called the CAPM beta. So the CAPM beta, one way to interpret that is to say, if the market moves by 10%, by how much does the dividend futures move? Right? And so the CAPM beta of the market itself is, of course, by definition 1. If the market moves by 10%, then the market moves by 10%. For a stock that has a beta of 2, it means that you get double that movement. Right? So you get a 20% shock. Here we're looking at dividend futures across the different maturities. And what you see is that particularly for the short end again, the loading on the market is actually relatively low. Right? So the CAPM beta for these 3, with the exception of the UK, which is a little higher, is actually close to only 0.4. And so there's a very low correlation, if you will, between the returns that you make on the market and the ones that you make on these dividends. And so this just shows you that this fits nicely as part of a diversified strategy. If we would find here that the CAPM beta was essentially 1 or higher, then essentially you were not diversifying a lot by investing in these dividends because all they did was track the market. This just shows you that the dividends have a very distinct pattern in terms of how they move relative to what the market moves are. And in some sense, that's also not that surprising, right? Because the dividends are only a statement about what happens to the dividends in the next year. The market is a bet on the whole present value of all the cash flows that the firm pays over, or the index pays. And so, of course, that has very different movements in it than just what this one period dividend does. The stock market has a statement about not just today's boom or bust scenario, but about all future boom and bust scenarios over the whole infinite horizon of the index. This is literally just a statement about what happens immediately now, and that is one of the reasons why you should expect that the correlation isn't as high between the two. So it is a more measured way of thinking about the next boom and bust cycle, a very specific zooming in on that particular event.
Is the volatility of the dividends less than the cash flow of the market and the earnings?
So as you can see here, you can see that the price moves more than the cash flows, right? So for example, this picture I think is the nicest, right? You can see that this blue line is more wiggly than what the realized cash flows are. Right? So another way of thinking about that is that there is quite a bit of variation in the expected return. And I already showed to you that that was the case in this picture here. So you see here that the expected return varies quite a bit over time. Right? And so they're quite volatile, but again, it's idiosyncratic risk. It is not risk that correlates with the rest of the market. Yep. And so if you think about the index as sort of a weighted average of all the individual years, right, what year 1, 2, 3, all the way out to say 40 years, then there's going to be some balancing point of which of the dividends is the most representative for the 40 that we have, right? It's somewhere in the middle. Another way of thinking about that is also, if you ask about a bond and you say, I want to know one summary statistic of that bond, then usually we just say the duration of the bond is 10 years. And then we know exactly that we summarize the whole behavior of the bond by just that one number, right? And so the closer we get to the duration of the stock, which is, say, 15 to 20 years on average, right, then you get more of the behavior of that particular dividend strip as well. How can I use dividend strips to actually do duration matching for if you're a pension plan or if you're an insurance company and you have particular obligations over a particular horizon? Before, you just invested in stocks and you sort of hoped that the duration of that whole stock portfolio had something to do with the duration of the obligations that you had. Now, if you want to fine-tune the duration of your investments to the duration of your liabilities, you can now do that in a very exact way. So I said most of this already, but does dividend investing add to your portfolio? Well, we've established two things. Historically, they've done quite well in terms of their average return. They've done better than the index. We've established that the CAPM beta, particularly for the short end, seems to be substantially below 1. So that just means that if you want to sort of do the alpha terminology where you say the return on the strategy is just simply the return of the strategy minus the beta times the return on whatever the benchmark is. Let's say that's the market. We're going to get a positive alpha out of this. And so therefore, this is a positive alpha strategy. And so therefore, as part of a diversified portfolio, it is beneficial to add it to your portfolio. And another way of saying that is dividend investments will expand the mean variance frontier. So you can shift up the average return and reduce the level of risk by adding it to a diversified portfolio.
Percentage did you add in your studies?
So the standard way to do it is to just simply say, is there an alpha and how big is it, right? And then how much of a bet you want to take on it, that's up to you. Right? All right. So now, after looking at this, you may say, well, does this fit into a broader pattern, yes or no? Right? Is this something very peculiar about dividends? Or is there sort of broader supportive evidence about the importance of short-term investments? And so after we really pushed this agenda on dividends in the academic literature, as is usually the case when you're lucky, is that several people will dive onto it and will try to see whether pieces of evidence in other markets are consistent with what you found or whether they're actually different from what you found. And as it turns out, particularly in terms of Sharpe ratios, meaning taking the average return divided by the risk that is involved there, it turns out that, which is one thing that we document for dividends as well, that it seems to be particularly high for dividends, you find that it holds everywhere. So there are now papers on government bonds, on corporate bonds or CDSs, on volatility trades. So the volatility risk premium seems to be particularly high at the short end relative to the long end. It seems to hold in housing markets. So the UK has a particular institutional feature where you can have freeholds or leaseholds, and therefore you can actually measure how shorter term housing does relative to longer term housing. And so we found it very comforting that it seems to be quite a robust feature, that compensation for risk at the short end seems to be particularly high relative to the long end, particularly in terms of Sharpe ratios. So there seems to be a larger pattern at play here, and of course future research will have to try to figure out what that common pattern is. One of the nice things for us was, from the academic literature point of view, of course not so much for the original writers of the models, was that these facts are just completely inconsistent with what we thought before. And if it now holds across all these different asset classes and not just in dividends, it's a bigger academic challenge to try to figure out why this is exactly happening. Does it have something to do with liquidity? Does it have something to do with institutional investing? Does it have something to do with preferences of people, that somehow risks that are at the shorter term are more salient to them, and therefore they want to get more compensation for them relative to further away risks that seem sort of, further from their current life sort of situation. It's unclear what the driving effect is. It is just that relative to a diversified portfolio, these short-term strategies seem to do particularly well. All right, so let me talk about some other applications really briefly, because I think I already mentioned several of them already. So the first one is duration matching. If you just take a particular stock and I say to you, here is General Electric, right? You get cash flows from General Electric, there's some growth priced in, there's some discounting, and now I ask you, with a corporate bond for General Electric, I say, tell me what the duration of the bond is. And then you say, well, I know the coupon, I know exactly what the maturity of the contract is, here's the maturity, it's 7.3 years. Now I go to the stock and I say to you, tell me what the duration of the stock is. Because we have cash flows that are laid out in expectation. And so therefore, in principle, you could compute something like a duration for that particular stock. But it's much harder to determine what that exactly is. You need to make a statement about what exactly the growth pattern is going to look like, what the discounting is going to look like, and so forth. In this particular case, for a dividends futures contract, you know exactly what the maturity is. A 7-year dividends futures contract has a 7-year maturity. Right? So if you want to do duration matching and you want to do it exactly, particularly in the equity-related space, then this is a very convenient and precise tool relative to what we had available before. And then finally, and I already briefly mentioned this too, what about inflation hedges? Well, if we want to get some insurance against inflation, we would like to ideally have something that over time grows with inflation. And one thing we know about bonds is that they just don't. A 30-year mortgage contract has, or a 30-year bond has 30 years of fixed coupons and a fixed principal, and there's nothing that's going to be changing about that. Now, of course, there are the real bonds that allow you to hedge inflation as well a bit. But the real bonds have all kinds of other issues in terms of their average return patterns that people don't particularly like. We had very low returns for those for quite a while. So here is a way of anti-hedging inflation while still getting exposure to quite some upside and some average return that looks more interesting. Right? All right, so let me just briefly summarize. So we did not have any particular agenda when we started working on this. We just said, we have no idea what this data looks like. In the academic literature, nobody's looked at what it looks like. And so why don't we just find out? Right? And so in the end, we found things that we found very surprising. And whenever you find something that is quite surprising from an academic point of view, the first thing that you do is you're skeptical, because you think, maybe I did something not right. How can this possibly be true? But then over time, the evidence starts to pile up. It doesn't just hold in one market. It doesn't just hold in the US. It doesn't just hold in the put-call parity relationship for options. It doesn't just hold in the futures versus spot for index. It doesn't just hold in the dividend futures market. It holds everywhere. It holds in volatility markets. It holds in housing markets. It holds in corporate bond markets. And so as the evidence starts to pile on that this is a robust finding, you're forced to change your prior beliefs. And so here's what we found, and still in the last 7 years, we've worked on it for about 10 years, we found very little evidence contradicting it so far, which is isolated dividends are an exciting new asset class. We can learn a lot from it. We can learn a lot from it in terms of how stocks are actually priced and where the risk premium on stocks actually comes from. Because we know that they earn higher average returns than bonds. But how does that, for example, relate to maturity? We didn't know that much about that beforehand. And so they seem to have high average returns, higher than we thought. Just to give you, in case you are a bit interested in the academic literature, essentially the academic literature consistently said a one-year dividend just needs to be discounted at the risk-free interest rate. There were very few models that said these things are sufficiently risky that you need to give this a very high risk premium, right? And so the fact that they outperformed just by themselves was a very puzzling thing from the point of view from the existing academic models that we had. They have high idiosyncratic risk, but low systematic risk. If you're thinking about applying them, so the conclusion from this is, as part of a diversified portfolio, they make a lot of sense. Applications, 3 in particular, betting on recessions, when they begin, when they end, duration matching in a precise manner, inflation hedges because dividends increase with inflation. And so as part of the broader evidence, I think it nicely fits in a picture of short-term assets seem to have higher Sharpe ratios than we thought they had before.
So the growth in dividends is much higher than 2% inflation.
Yes, for sure. Because there's real economic growth as well.
And for
right?
the past 10, 20 years.
Yes, for sure. But the interesting thing is that that's another way of saying that they earn high returns, right? You can just see, suppose that you just first operated under the impression that there wasn't a risk premium. Then you can just frame the whole problem as how much growth is the market pricing in for dividends over the next 10 years? And if you then find that the market is pricing in that it will only grow at 2%, say it's equal to inflation for the next, and you know that there's real economic growth too, that's another way of saying dividend is cheap and there is a return to be earned. Right? Yes?
Is it inaccurate to compare these versus tips? Perhaps it's not a duration mismatch, but I would think these would outperform tips massively because of the cash flow.
Yeah, because in the end, the tips, other than that they compensate for inflation, they still have no other growth in them, right? This does have other growth priced into it, but it is also riskier in some sense, right? I mean, when firms start to cut their dividends in a particular year, tips won't give you a negative return. These ones will. So the volatility of the strategy, again, in standalone fashion, is not low. As part of a diversified portfolio, it is quite low. because it diversifies well against other investments that you have. Yes?
How were you able to separate out the risk premium from the growth assumption?
Well, so there are really two ways. One is you can just build a forecasting model for dividends, right? And so the standard academic methodology for that is what we call vector autoregressions, where you have a VAR model with particular indicators. But what you can also simply do is there is a dividend forecast market. And so there are parties that will just sell you for particular firms and also at the aggregate index level what their forecast of the realized dividends are going to be over the next 1, 2, 3 years. And so whether you use one or the other doesn't really make a big difference. Right? You come to very similar conclusions. Yes?
I believe there's also the academic theory that dividends are
Again.
stock versus
Yes.
dividend.
Yeah, so one way of saying that is dividends are so cheap because people are constantly worried that the firm will permanently decide to no longer pay dividends but instead do everything to share buybacks.
Or
That-
if you invest
right?
in dividends, are you exposed to this other risk of a decision of the marketplace to buy that? Let's say, for example, you hear the politicians talking about stock buybacks being bad,
Yes,
right?
that's very good news for dividends, right?
Exactly. But certainly,
So let them go, It's totally fine.
but it's a double-edged sword, I guess, is my point. If there's an upside to that, there's also a downside.
No, there is.
It's not really a macroeconomic risk.
Yes.
It's a behavioral risk.
Well, I'm not sure that I would call it that for the following reason. In the end, there are a bunch of risks that are correlated with a bunch of things, right? It is still a risk that affects the dividend. It is correlated with something particular, which is an institutional environment, right? One of the reasons why in general, investing is a risky thing because, governments can decide to do with property rights what they want to do, and if they make crazy decisions on that, you can lose a lot of money. And in emerging markets, we've seen that happen. Right? And so the fact that a regulator actually adds to the amount of risks that we see in the marketplace is not something new and also not necessarily something I would call a behavioral risk. I think I would just call that regulatory risk. But I do take your point very, very seriously in the sense that, yes, if there was a substitution away from cash dividends into buybacks, that's bad news for dividends. If there's a substitution away from buybacks into dividends, that's good news for dividends. The fact that the regulators don't quite understand that the two, due to basic math arguments are identical, but maybe is indeed somewhat disappointing, although we've seen more disappointing things than that. Yes?
It seems the research for supporting dividend investment is more centered around shorter maturity.
Yes.
So I guess my question is probably more related to the ETF product itself. Does that mean you only harvest like 1 year to 5 year dividend? So the futures contract enter into, you don't suggest go longer?
Yeah, but if you look at the cumulative, I showed some pictures about the cumulative return patterns across the maturities, right? So that was, sorry, did I not do this right? Yeah, it's here. There it is. So you do see that it depends a little bit on the market, right? So for the US, the somewhat longer maturities actually have done quite well. For the other countries, it is indeed true that the longer maturities have not done as well as the shorter ones. But again, compare that to what the index has done over that same period of time, right? And so relative to the index investing, it's still, I think across maturities, it has just done quite well. Yes?
So, I'm trying to explain I guess, the heightened risk premium that exists here, or I'll call it the underpricing of forward dividends.
Sure.
Have you done any research or seen any evidence that it's caused by, say, structured product books around the street that basically, promise clients the price return of an index with some guarantee, and then they basically are all long the dividends, they need to hedge them out and sell?
Yeah.
Have you seen the evidence of that?
So in the end, let me say two things to that. So first of all, yes, that's one hypothesis that we had. To getting the appropriate data to show, which is what we're interested in, a causal relationship between those two things is another ballgame.
Find anybody to hand over their forwards book and dividends?
But even if they, but even if they would hand over their books, right? The causal relationship means that I somehow need exogenous shocks to something so that I can really say the change in this caused that. Otherwise, we're just documenting correlation.
Liquidate his book, and then you'll be able to see the behavior.
Yes. And so even if I had the data, I'm not sure whether I'd be able to prove the causal relationship, yes or no. But I can certainly tell you that is one of the hypotheses that is on our list and one that we've been thinking about. But we need to come up with a smart empirical strategy to prove it one way or the other. Without that proof, it will be an empty claim. Yeah. Yes?
But you would agree, from a supply and demand perspective, if you're in the business of selling structured notes, your hedging position is to sell.
Sure, sure it is.
Trying to hedge your dividend.
Sure, but
Or not,
yes.
supply and
No, that's true, but I completely agree with that. But then on the other hand, I mean, there are lots of things that we want to hedge, and generally we hope that markets are able to accommodate supply and demand such that you get a fair price, right? I mean, if people are trying to hedge, but at the same time all the insurance companies and pension plans say, hey, we want to do duration matching, this is such a good trade-off, let's massively buy it, yeah, then they're just going to drive back up that price, and then eventually the prices will cover. Sorry, Dave?
But they're not there yet. Like,
Yeah, well.
There's no other side of this trade yet. I mean,
Yeah. Well, I think yes and no. So there isn't to the extent that the return has been competed away. I think that's clear. Although it is still possible that there's some rational reason why the risk premium would be so high. Maybe there is. I doubt it, but it could still be. I want to be an open-minded academic. The other thing that I was going to say was that the reason why we started looking at the dividend futures to begin with, after doing everything with the options market, was because one of the discussants at a practitioner conference was in fact from a pension plan and said that they were already massively implementing the bet to begin with. And therefore they said you should really look at this data too, because it essentially confirms what you've been saying based on this other data. And we've been doing this trade for quite a while now, and it's actually one of the largest pension plans in the world that's doing it. So I think.
The question is, who's selling dividends? Right? Because every time
Yes.
you buy dividends, somebody's selling.
Yeah, sure.
So who is selling dividends?
Yeah,
Who's net short dividends?
yeah, that's a great question, but yeah. Can I? Somebody who hasn't asked the question yet? Yes.
I'm going to try to squeeze in two questions. It's fascinating. The one is, Shil has done a lot of work on PE ratios.
Yes.
PE ratio, a lot of statutory power on
Yes.
future wealth pricing. Now, in looking at the dividends, you show a correlation with GDP.
Yes.
Have you tried to split out the impact of PE ratios versus the impact of GDP? Because I would suspect that the impact on PE ratios is much less on the dividends than is the impact of GDP.
So absolutely. So that was one question. So the second one was coming, I'm sure. But let me just quickly answer that one so that I don't forget it. So the PE ratio is something about the aggregate market, right? And when we looked at the CAPM betas, we actually looked at the returns on the aggregate market, which drives that PE ratio, relative to how the dividends were doing. And indeed, that correlation, particularly at the short end, wasn't as high. Right? So that exactly confirms what you said earlier. And so one way indeed to think about the yields that I showed you is, it's not the price dividend ratio of the market that's the yield variable, it's now the price dividend ratio of the 5-year dividend. But it's still a price dividend ratio sort of thing, right? It's a dividend that's paid out in 5 years relative to what the dividend is today, as opposed to the PE ratio or the price dividend ratio is just all the dividends that are paid relative to the dividend today. Yes, second question? Sure. Yes.
It's, you strip the dividends out of the stocks. The remaining stocks now look quite different to what let's say it's on the S&P 500 and what the S&P 500 does.
Well, so this is another great question for the following reason, right? And I think we often underestimate this. If you take the sum of the first 10 dividends for the next 10 years, right, and you know that a 1-year dividend yield is about 2%, that means that the first 10 years of dividends are barely 20% of the total value, right? So 80% of the value of the stock is going to come from stuff that happens after that still. And so if you say strip out the first 2 years of dividends from the aggregate index, it's 96% of the dividends are still the same between what you stripped out and what you had before. So that correlation is still going to be relatively high. right? And it's just that the short-term dividends aren't quite as large a fraction of the total value as you would think. Right? Another way of saying that is, that's the equivalent statement, the duration of stocks is just quite high. Right? It's much higher than a couple of years. Yeah? Yes, there was a question there, and then we'll do the question there. Yes?
Yes, back in the 1980s, a company called America's Trust had primes and scores that were, and one of the we bought a lot at the trust department I was with.
Yep.
The problems was that the dividends, they wound up covering like 80 or 90% of the dividends, and because there was a liquidity issue, and they weren't able to capture all that they had promised in the trust. How is this product different, and why wouldn't it happen, again like that?
But right now, we simply have a contractual agreement in a dividend futures contract that says, at maturity, I pay X, and we have a contract that says how we specify and how we sum up what the aggregate dividends are of the S&P 500, and the counterparty in that dividend futures contract is obliged to pay that. Right? So particularly, so say in a dividend futures setting, there's the issue of do you physically need to go and collect the dividends isn't quite there, right? It's just a contract between you and me where we just have an underlying that we have agreed upon what you're paying me and what I pay you, and that's it. And that's the data that I've been showing you here.
So
Yep.
that would be the structural difference.
Yes. And yeah, question there.
It's obvious that the futures market is overpricing risk, especially in the short term.
Apparent.
Is this a true market inefficiency? I think you said you might not know. And should it get armed out over time?
Yeah, so what you're asking for is the holy grail of finance, right? Which says, do I know whether it's correctly priced and whether it's a risk premium, or do I think it's mispricing? We have seen a huge rise in factor investing, right? Everybody's now starting to get convinced that factor investing is the right thing to do. Are factors compensation for risk, or are factors simply mispricing that you're harvesting an alpha on? Right? Do we know whether that's true? Right? Certainly, the approach that the academic literature has taken so far, in my opinion, has been very disappointing, because what has the academic literature done so far? They said, we discover a factor that does well. We can't explain it. Then we put that factor on the right-hand side of the equation, and once you've moved it to the right-hand side of the equation, the model suddenly does really well. Right? And this is, so we've moved from the CAPM, and then the CAPM was a one-factor model, and then the value factor was introduced, and then the momentum factor was introduced, and then the size factor was introduced. And so the leading academics, including some of our Nobel Prize winners in the field, are people that every year they go from the 4-factor model to the 5-factor model to the 6-factor model to the 10. I mean, so my co-author, Jonathan Burke, who's not in this paper, and we wrote a somewhat, piercing piece in which we said, we used to have the Earth at the center of the universe. And every time we saw a planetary movement that we didn't like and didn't fit the model, we added an epicycle to it. And once the epicycle was added, it explained the planetary movements really well. And then Copernicus came along and he said, well, let's put the sun in the middle, but he accidentally assumed circles and not ellipses. And so the correct model actually underperformed this hugely overfitted epicycle, so that so many epicycles that it perfectly fit the planetary movements. So to answer your question precisely, it is a constant discussion about what are reasonable compensations for risk and what is mispricing, and that's not a debate that we're quickly going to settle on. But I think that, as an investor, you need to decide for yourself whether you consider this to be risk, yes or no, and whether this is a good investment for that reason, yes or no. Right? Certainly relative to everything that we've seen before and what we previously thought were correct benchmarks, it seems to have quite a high alpha. That's all I can tell you at this point. Whether you now want to take the short-term dividend factor and put that one on the right-hand side and say it must be risk, so let me just put it there, I'm not too convinced that I want to do that at this point. Yeah.
One more question. So what's the investment case for price return? Obviously, to generate that, you have to strip out the stock investment into dividend part and price part, right? And this obviously is very attractive and has its use cases. Then who will buy the price return piece? If they don't buy it, how do you generate that?
No. So the question, but that, in some sense, the question you're asking is the same question that he's asking, right? Right? Because if it truly is mispricing, then the question we immediately have to ask is why doesn't everybody already do it, right? But that's the chicken and the egg problem, right? And so if I can't answer the question, do I know for sure it's mispricing? Well, certainly relative to what we thought we knew before it is. Is there a reason why people are not buying or selling it, which is the same as saying there's some risk factor underneath that explains that? I think that's an open question at this point that I don't have a convincing answer to yet, although I'm thinking about it. But you know, if I could crack that for this problem, then I could crack it for all the rest, and I think asset pricing would be, as a literature, an academic literature, would be much further than it is today. Yes?
So, for one, disclaimer up front, these graphs are not as clear to these old eyes as they might have been 10 years ago. But you know, it looks, to what extent, if I see the underlying index and the dividend return streams, how much of the incremental outperformance is alpha, and how much of it is compensation for what appears to be much higher volatility? Not beta volatility, but just absolute return stream volatility.
Yeah, but the thing about modern portfolio theory is that the main insight that Sharpe gave us was that the only thing that deserved extra compensation was the risk that wasn't total return, was only the systematic part and not the total return volatility part, right? The feature of idiosyncratic risk is that it can be diversified away. Now, if you as an investor choose to not diversify it away, then that's your own choice. But you always have the opportunity as a diversified investor to put it as part of a larger portfolio, and then that risk won't harm you. Now, if you're saying, well, I just think that people are not understanding diversification very well, and one of the reasons why it's mispriced is because they look at total return volatility and they don't understand that as part of a diversified portfolio, you can do much better. Well, then you have even a better reason to then put it in your diversified portfolio because you're getting return for free. And then you've given a theory for why you think it could be mispriced. Second answer, you don't look as old as you pretend to be. Yeah, we have to go to the bell, right?
Yes. Jules, thank you. That was fantastic.
Thanks so much for your attention.